Hey there, everybody. I'm Logan Alec. I'm a CPA. I own Choice Tax Relief, where we help everyday Americans fight the IRS regarding their back tax debt. Today, we're talking about bankruptcy. I'm going to go over a bankruptcy court case out of the Eastern District of New York. It gets into the question of whether or not a certain taxpayer's taxes could be discharged in bankruptcy. And the bankruptcy court decided no, that this particular individual's taxes were not allowed to be discharged in bankruptcy, and we'll get into why. But first, I want to remind you of the basic requirements for a tax to be discharged in bankruptcy. Now, there's three kind of timing requirements that are quite objective, and there's another requirement that is based on facts and circumstances that is maybe not so objective, but let's go through them. First requirement is the tax must have been due. The tax you're looking to discharge in bankruptcy must have been due at least 3 years before you file your bankruptcy petition. Second requirement is the tax return pertaining to the tax in question must have been filed at least 2 years before you file your bankruptcy petition. And number 3, the tax in question must have been assessed at least 240 days before you file your bankruptcy petition. Now, these are very objective. They're based on the calendar. You can look at the calendar and see if these requirements are met. Now, the last basic condition, maybe it's not so objective. Maybe it's a little bit subjective. And that's why, and that is actually the nature of this court case that we're going to talk about here today. And that requirement is that the tax in question must not relate to a fraudulently filed tax return or a tax return that involves fraud, and the taxpayer must not have attempted to evade the tax in question or defeat the tax in question, is the language of the law. So, and it's that test there that the court determined that this particular taxpayer, name is Anjanie, failed to meet. So the case is Anjanie versus United States. This was when was this? This was just on June 11th, I believe. Right here, dated June 11th. So let's get into the facts here and see why. Why did the bankruptcy court, Eastern District of New York, decide that Ms. Noreen's tax debts was not dischargeable in bankruptcy? This was actually, the court here granted summary judgment to the United States, the defendant in this case, and you know, in a case like this, the defendant can make a motion for summary judgment, which means, hey, we don't need a full trial here. We want the court to kind of review the facts here and make a decision on the matter without going to full trial. And that's what happened here. And the court granted the United States the defendant's motion for summary judgment, basically saying, hey, this individual here doesn't really have a leg to stand on. So let's see why. All right. So here's the basic what's going on. Noreen owes over $40,000 to United States for unpaid taxes and penalties and interest. The debt stems from plaintiff's failure to report over $90,000 of capital gains on her 2017 tax return. Okay. And there's a chart down here showing all kind of her stock transactions. So she made like $55,000 on Tesla stock and like $37,000 on Apple stock for a total of about $92,000 there. Let's go back to the top here. Okay, so this is back in 2017 tax return. I believe those first three requirements for a tax to be discharged in bankruptcy, she met those qualifications, right? The timing related qualifications. And so she filed for Chapter 7 on February 15th, 2022. And then on July 11th, 2022, the United States of America, the IRS here, answered the complaint and filed its motion for summary judgment. And what we're going over here today is the court's granting that summary judgment because it believes that Anjanie and Irene doesn't really have a leg to stand on here, and they're not going to go through a full trial here because just the plaintiff doesn't really have a case. Okay, background. Plaintiff's personal background. Plaintiff was born 1976. She has one daughter who was born 2006. She suffered childhood trauma, was diagnosed with dissociative identity disorder. It says she went to college at night, received a Bachelor of Business Administration and Economics from Pace University. She worked part-time in an accounting firm called Levine and Seltzer and developed a friendship with one of the partners, Philip Seltzer. It seemed, and this guy pops up in this case a bit. They had a falling out and did not speak again until 2020. And that Mr. Seltzer provides some tax assistance to the plaintiff in 2020. They have kind of a weird relationship. I don't know what exactly was going on here. I mean, it seems like a weird relationship between kind of a partner in this accounting firm and this part-time employee. It just seems kind of strange that they have this falling out, and I don't know. It's kind of weird, the relationship there. Anyway, yeah, and she was like an executive assistant, right? She worked at other places, clerical duties, managing her employer's calendars, blah, blah, blah. Due to her mental illness, she has poor interpersonal skills, has been laid off or let go from almost every job she has had, gone through approximately 20 different jobs. And in January 2023, she stopped working altogether. It says, while working as an executive assistant at the different financial firms, plaintiff learned how to trade securities. That's interesting. And she started trading securities in around 2013. And in 2017, plaintiff lost her job and started day trading securities using her own cash and retirement funds, right? And she had some success in 2017. She made $92,000 in 2017. Talks about where she held her money. And look, so yeah, so in the early months of 2017, January and February, she sold these stocks in her Vanguard account, $92,000 gain. And she received, 1099s for the capital gains, right? And a little bit of dividend income from the Vanguard account. If you have a stock account, you're very familiar with that year-end statement that your broker gives you. Gains and dividends are reported on a year-end tax information statement from Vanguard. And she self-prepared her return. She said she followed on-screen prompts to enter her information on the return. She did enter the $2,427 of dividends report on her Vanguard year-end statement, right? So we know that she got that statement from Vanguard, right? She got it. She saw the $2,427 on it. She followed on-screen prompts to complete various other lines, forms, and schedules of her 2017 tax return. And on that return, she reported adjusted gross income of only $85,000 and that she was due a refund of over $8,000. Okay, she filed this return in June 2018, and the IRS credited a portion of this refund to an unpaid tax liability for 2015 and refunded the difference. So she did not report the $92,000 in capital gains. She testified that she did not recall seeing a prompt for capital gains from the tax software, and that her failure to report them was a mistake. She does not dispute that taxes on the capital gains are due. She made some other mistakes on her return. She overstated her HSA contribution, blah, 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 and that's not really too relevant. And so because she didn't report these stock transactions, the IRS mailed her a CP2000. We've talked about CP2000s here a lot on the channel, which proposed changes to her 2017 tax liability, notifying her she had underreported her 2017 income by over $93,000 due to the unreported capital gains and the over reporting of HSA contributions. Told her she's liable for additional almost $24,000 in federal income tax, plus penalties of about $7,000 or $8,000 rather. Right, so proposed amount due was $31,851. Right, we've gone over CP2000s a lot on this channel. If you want to see a video on CP2000s, check out the video here at the top of the screen. Right, and then the IRS sent her the CP3219A. Right, so the CP2000 is a 30-day letter. CP3219A is a 90-day letter, basically giving 90 days to petition tax court, 150 days if you live outside the U.S. And if you don't respond to that notice, right, or even if you do respond and IRS AUR doesn't process your response, which happens a lot these days, then the IRS will then assess the tax and potentially take collection activity. Okay, so this is basically telling about the tax court rights here. So but she didn't challenge it. She knew that she owed the tax on the $90,000 or 90 whatever $1,000 of capital gains. So she consented to the assessment and collection of the deficiency. She contacted the IRS, inquired about setting up an installment agreement for a 2017 liability, but the IRS requested that she file her 2018 tax return first. One of the things about getting into an installment agreement with the IRS is the IRS wants you to be in compliance with your outstanding tax returns. Plaintiff recalls being in talks with the IRS that the talks stalled, but does not recall other details. Plaintiff did not obtain a payment plan and then started to receive deficiency notices, right? Notices that she needs to pay up or else. Or actually, notices that the IRS is going to assess this liability. So, and on November 11, 2019, the IRS assessed the liability, sent a notice of demand for payments. The IRS sent her 2 delinquency notices informing her that she needed to file a tax return for 2018, probably like a CP59. One in December 2019, another in February 2020. It says plaintiff did not file her 2018 tax return until March 2020. On January 20th, 2020, the IRS sent plaintiff a CP504, statutory notice of intent to levy. We've talked about the CP504 here on the channel. Link to that video at the top of the screen. Okay. Okay, so then she talks to her old boss about these tax issues, right? In 2020, plaintiff told Mr. Seltzer about the tax issues, inquired whether she could carry back stock trading losses incurred after 2017 to offset the gains in 2017. And then there's this kind of back and forth here where basically it said basically her old boss, this Seltzer CPA guy, testified that Mr. Seltzer said he would, I think, amend her returns. Right. So created the amended return, set signature pages of the plaintiff. That's the individual here, Noreen. Plaintiff signed the documents and dropped them off at Mr. Seltzer's apartment building, but he didn't file them. Plaintiff claims she learned only recently amended returns had not been filed. Plaintiff has not heard from Mr. Seltzer, right? And apparently this guy is has pretty bad depression. She had concerns about his well-being, said I had gone to his apartment and he had mountains of mail, like probably 2 years worth of mail that had piled up on his table in his living room. Plaintiff recalled Mr. Seltzer telling her like he gets so much junk mail, gets so many statements, don't want to open them, don't want to go through them. So every day when the mail comes, he just throws them in the pile. Wow. How would you like this guy for your CPA? A dude that according to her, his old employee goes weeks locking himself away. Wow, I wouldn't want to hire that guy to do my taxes, right? And he didn't file the amended return for this Noreen person, but that's kind of not really here nor there, because this is really the crux of what we're going to get into now is really the crux of why the bankruptcy court granted summary judgment to the United States, saying that now this lady can't get rid of these taxes in bankruptcy. It's this discretionary spending and assets. Okay, so now it's going to get into what she did with the money instead of paying the IRS the tax. On July 8, 2019, okay, she withdrew over $2,000 at Bally's Atlantic City and withdrew approximately $560 from an ATM in Spain, and she paid off $7,000 of credit card debt. And she also went and got some loans in October 2019 and got $15,000 from Marcus by Goldman Sachs, $16,500 from Barclays. But what did she do? She did not use the loan proceeds to pay the outstanding taxes. Instead, plaintiff used the money for day trading stocks. So this is what really ticks the IRS off, right? And this is where they start crying evasion, tax evasion. It's when you have the means to pay your tax, but you choose not to. You choose to day trade stocks with the money. You choose to pay off other debt with the money. Yes, the IRS thinks you should pay them first, right? There's some other stuff that she does too with some money she has. A bracelet business. Yes, we'll get into it. And look, she has money, right? I mean, despite I mean, we read it earlier. She has this, condition and mental health issues, but she's still been able to work jobs and accumulate um, a nice little nest egg for herself. Right, as of December 31st, 2019, the fair market value of plaintiff's IRA portfolio is $344,000. Now, a lot of this is probably because she learned how to trade stocks working at those firms, right? So maybe that has something to do with it. Right, and in 2021, the plaintiff distributed $96,000 from her Fidelity IRA, and it appears that she used the money to make stock trades, suffered from some losses, and within 60 days deposited $89,000 back into the account to avoid having to pay tax on the full distribution. And then here's something that I'm sure that the IRS, I'm sure, really ticked them off when they learned about this. In or about 2019, the plaintiff's teenage daughter's interest in climate change prompted the plaintiff to start a business selling bracelets to raise awareness. In November, December 2019, the plaintiff took a 2-week trip to China and spent $10,000 on goods to start the bracelet business. Also in 2019, the plaintiff traveled to Brazil to locate a specific type of jewelry that she could also sell as part of her business. The plaintiff only sold $250 worth of bracelets. However, the plaintiff explained the business was not to sell bracelets, but for the bigger purpose of generating climate change awareness. The plaintiff made additional donations to organizations committed to fighting climate change. And they kind of have this list here of all these trips that she took. Spain, Dominican Republic, Los Angeles, Hawaii, Florida, the Bahamas, Florida, Bahamas, Florida. IRS looks at this, it ticks, and the bankruptcy court as well looks at this, and this really ticks them off. They're like, you went traveling with our money. You did this bracelet thing with our money, right? Because if you owe the IRS money, they see anything you do with that money other than basic living expenses, right? Putting food on the table, a roof over the head for you and your family, and they even limit how much you're allowed to spend on that through their national standards. They basically view this. Oh, you went to China with our money, right? You went to Brazil with our money, right? This bracelet thing. This was just, a fun little thing you did, almost like a hobby, right? You only made you spent tens of thousands of dollars, you only made $250, and all this travel. They're saying you traveled with our money. That's their perspective. It says she would pay for these trips with her savings or credit cards. Plaintiff explained the 13 trips within 18 months were meant to meet her daughter's emotional needs and in some cases to allow her to visit her sick grandfather in Orlando. Okay. So then the court gets into a legal discussion about summary judgment, right? Basically stating that they can enter into a summary judgment if factual disputes are irrelevant, right? So we can kind of move past these legalese and get to where is it here? Let me pause it where I got to find the relevant part. Here we go. Standards for non-dischargeability under Bankruptcy Code. Bankruptcy Code Section 523A1C provides that Chapter 7 discharge does not discharge an individual debtor from any debt with respect to which the debtor made a fraudulent return or willfully attempted in any manner to evade or defeat such tax. So there's two prongs here. If the debtor meets one of those, right, tax cannot be discharged in bankruptcy. Okay, so let's see what the court's thinking here is with respect to Ms. Noreen. It cites a lot of case law. Let's get into the discussion of Noreen. Right, and so basically the court says, look, Ms. Noreen attempted to evade or defeat the payment of tax. Okay, and we're going to see their logic here. The debtor's failure to disclose the $93,000 of capital gains in her 2017 return is conduct constituting an attempt to evade the payment of taxes, right? For those of you out there who haven't filed your required tax returns or who haven't reported all the income the IRS has on you on your tax returns, right? You're not reporting the income, you're not filing your tax returns. IRS courts could say, hey, that's you attempting to evade the payment of taxes by not filing those returns. Plaintiff's claim that the omission was just a mistake is undermined by her inability to explain how she missed reporting a relatively large portion of her 2017 income, right? So they're kind of like, this isn't adding up. You say it's just a mistake, but you've worked at an accounting firm. You've worked at financial services firms. You probably knew that you should have reported $90,000 of capital gain on your return, right? But more than that, plaintiff's failure to pay any portion of the liability, even though she had the money to do so, establishes an attempt to evade or defeat the payment of tax. From 2019 to 21, plaintiff had between $300,000 and $1 million in her IRA. And I mean, she wasn't like terribly old at the time either. When was she born? She was born in 76, I think. 76. Right. So in 2021, what was she? She was 45? 45, right? That's pretty good at 45, right? I mean, especially someone who was, kind of just in an executive assistant, not necessarily like a C-level role throughout her career. Having $1 million at one point in her IRA, that's pretty good, right? During that same period, plaintiffs had $20,000 to start the bracelet business and thousands of dollars for travel. Plaintiff's discretionary spending is significant relative to the debt owed to the IRS, which as of April 2019 was $31,851. Also during that time, plaintiff spent $7,000 to pay a credit card bill instead of paying the tax bill. Furthermore, in October 2021, the plaintiff borrowed over $30,000 but used none of the loan proceeds to pay the tax liabilities. Based on the foregoing, the court concludes the plaintiff had the ability to pay the tax debt but chose not to. Okay. She also failed to file these tax returns, right? That's contact evidencing an attempt to evade paying taxes. Claims she relied on her old boss, Mr. Seltzer, to file her tax returns. But, by her own admission, she knew that she did not open his mail, suffered from debilitating depression, would lock himself away for weeks, and stopped communicating with her. Not the kind of guy you would probably want to trust to do your tax returns. Despite Mr. Seltzer's known illness and history, the plaintiff failed to verify that her tax returns had been filed. Further, Mr. Seltzer's email to the plaintiff advised her that IRS could disallow lost carrybacks, and if that were the case, the plaintiff would be liable for the tax on 2017 capital gains. Plaintiff disregarded Seltzer's warnings. Plaintiff's conduct was willful. Although the intent element is distinct from the conduct element, courts consider taxpayers' failure to pay taxes financially to do so as both conduct and evidence of willfulness, right? So, she did not pay the taxes, right? That's a fact. And they're saying, well, it's evident that she willfully did not pay the taxes. Her conduct was willful because she had $1 million in her IRA at some point. She spent $20,000 in the bracelet business, more money than that traveling, and she didn't pay her $30-some-thousand tax bill, right? As set forth above, the debtor had sufficient savings to pay the 2017 tax liability, but paid none of the debt. Instead, she used her savings to start a business, day trade, travel, and pay credit card debt. The court believes the plaintiff's explanation of the bracelet business and travel expenses are motivated by plaintiff's love and concern for her daughter. That's cute and sentimental, but the court and the IRS do not care about cuteness and sentimentality. However, the test for whether a taxpayer willfully evaded taxes is not whether the taxpayer believes she used disposable income for a purpose more righteous or rational than paying taxes. Rather, at its core, the test is whether the taxpayer knew of the duty to pay taxes. She did. Whether they had the ability to pay. She did. And whether she chose not to. She did. So, conclusion. For the foregoing reasons, the court finds that the plaintiff willfully evaded her tax obligations for the 2017 calendar year. Therefore, her claim is non-dischargeable. This tax cannot be discharged in bankruptcy because she doesn't meet that fourth condition that I talked about here at the beginning of the video and that the court described here. Bankruptcy Code Section 523A1C provides that a Chapter 7 discharge does not discharge an individual debtor from any debt with respect to which the debtor made a fraudulent return or willfully attempted in any manner to evade or defeat such tax. Neither party requested the court to fix the amount of the claim. Therefore, the rights of all parties and interests are preserved respecting the amount of the claim. The defendant is directed to submit a proposed order consistent with this decision within 14 days of entry. United States motion for summary judgment is granted, and Ms. Noreen cannot discharge her $30-some-thousand of tax debt to the IRS in bankruptcy. Folks, should make you think. We get lots of people who call up. Hey, can I file bankruptcy on my tax debt? Yeah, there's those three requirements, right? that are objective, the timing requirements. But there's these other requirements, right? That you can't have willfully, evaded tax, right? The return, there's issues with the returns. And the bankruptcy court, you can see how kind of deep an analysis they do when determining whether or not it should grant discharge of certain taxes in Chapter 7. So this should make you think, folks. And obviously, you might not be in the Eastern District of New York, but this is just an example, right? Not saying it's precedent everywhere, but it just kind of goes to show the kind of analysis and depth that a bankruptcy court may do when deciding whether or not your taxes qualify to be discharged in a bankruptcy. If you'd like more information about tax relief programs, check out the videos on the left-hand side of the screen. If you'd like to talk to us at Choice Tax Relief, give us a call, 866-8000-TAX, or visit choicetaxrelief.com, fill out the form on our website. We would be happy to talk to you. All right, folks, thanks so much for watching this video. Hope you enjoyed it. I know it's kind of long, but I'll see you in the next one. Bye-bye.